Hello and welcome to a new section of this course. In the following videos, I will show you how to do a discounted cash flow analysis. I will go over essential financial ratios and how to use them. I will show you how to create an optimized stock portfolio and which formulas you can use. Also, I will go over mortgage and payment analysis and calculation. So let's get started. Central to the success of any company is the investment decision, also known as the capital budgeting decision. Assets acquired as a result of the capital budgeting decision can determine the success of the business for many years. When deciding, we need to discount all future cash flows that we expect to get from the project to determine if the project is feasible or not. Why we do that? It's because the dollar in the future is not worth the same as the dollar earned today. Net present value is defined as the present value of the cash flows from an investment minus the initial investment. For this calculation, we also need a discount rate, also known as the opportunity cost of capital. It's called like this because it's the return you give up by investing in this project. But you also need to account for risk. A risky dollar is worth less than a safe one. The discount rate is the interest rate used to determine the present value of the future cash flows in the discounted cash flow analysis. This helps determine if the future cash flows from a project or investment will be worth more than the capital outlay needed to fund the project or investment in the present. The net present value rule works for projects of any duration. Simply discount the cash flows at the appropriate opportunity cost of capital and then subtract the cost of the initial investment. Let's see this in practice. For this example right here, we first need to estimate the cash flows. We have an initial cash outflow over the initial investment in year 0 of $5,000. Then for year 1, we have a cash flow of $1,500. In year 2, we have $1,320. Year 3 is $950, and then for year 4 we have $1,300. And we have our discounted rate of 11%. Now we're going to discount these cash flows in the following way. The present value of the initial investment is the same, so we do not have to discount that amount. Our first future cash flow in year 1, we will discount it in the following way. So it will be the cash outflow in year 1 divided by the 1 plus the discount percentage rate to the power of number of years. And this will be year 1. You can go back to the formula and lock the discount rate, so it's easier for you to copy the formula. And now you can copy the formula to the right. You can see that each cash flow for each year was discounted by the same discount rate, but the time or the number of years have changed. Now we just need to sum these numbers. So write in sum and then select all the present values. And we got that the net present value of our project is negative, which means that we should not proceed with this project. There's another way to calculate the net present value because Excel has a formula to do that. So type in equals NPV, open the parentheses, select the discount rate of 11%, put in comma, and then we can select all the future values or the future cash flows of our project. So select everything from year 1 to year 4, close the parentheses, and then subtract the initial investment. In this case, I put in a plus sign because we have already written an initial investment as a negative number. And we obtained the same net present value. Something to be careful about and not to be confused in the future. Let's say that I have the same numbers and the same project, but I've included our initial investment in a different row. And instead of writing it as a negative number, I've left it as a positive number. So our NPV formula would look the same, but in this case, if you observe the formula bar, I had to put in a negative sign to subtract the initial investment. It's the same formula, everything works the same, but you need to be careful when writing your table how you written this initial investment, as a negative or as a positive number. But however you calculate it, we obtain the same result. Our net present value is negative, and we should not proceed with this project. Thank you for watching. In this video, I'll show you how you can use NPV and discounting method to determine the value of a stock. The dividend discount model is a quantitative method used for predicting the price of a company's stock based on the theory that the present day price is worth the sum of all of its future dividend payments when discounted back to their present value. It attempts to calculate the fair value of a stock irrespective of the prevailing market conditions and takes into consideration the dividend payout factors and the market expected return. If this value obtained from the dividend discount model is higher than the current trading price of a share, then the stock is undervalued and qualifies for a buy, and vice versa. But let's explain this theory through this example. In this example, we have a share price of Coca-Cola, and we perform a dividend discount model. To determine this value per share, we need few parameters, but we also make some assumptions. Primarily, our cost of equity we assume to be 10%, and for the return of equity we assume to be 12%. Everything else we can get online on Yahoo Finance. So the current stock price is $62. The dividend for each share is $1.68. We have the payout ratio of 70.77%. The retention ratio refers to the percentage of net income that is retained to grow the business, rather than being paid out as dividends. This is calculated by subtracting 70%, which is our payout ratio, from 100. Then we have the expected growth rate for our dividends for the next 5 years, and this is 24%. And then we are left with the long-term growth, which is the percentage that each dividend will grow after this first 5 years pass. So first 5 years we have the growth rate of 24%, and after that in year 6 we have the growth rate of 4%. And now we can set our table. We set our years. We are starting in year 0, which is 2022, and then we set the growth rate for each year. And we can copy this from the table above. We can connect it. For the years of 2023, 24, 25, 26, and 27, we have the same growth rate, and this is 5 years, and this is 24%. And for the 6th year, we have the long-term growth rate, which is 4%. And then we can attach this growth rate to our dividend. So in year 0, we have the dividend, which is $1.68. And then for each subsequent year, we just multiply the dividend from the year before with the growth rate for that year. And as you can see, the dividend from the year 5 will not grow by 24%, but rather with 4%, and so on. And then we have to set our terminal value. Terminal value determines the value of a business or project beyond the forecast period when future cash flows can be estimated. We get this terminal value by dividing the dividend in year 5 by the difference of the cost of equity and the long-term growth. And this is the formula to calculate it. What we got is basically the expected stock price at the end of this horizon. And now we just have to sum our cash flows. So just sum the dividend with its terminal value. For the first 3 years, we have nothing. We just have the dividend, and this is it. And for the last calculation, we have our NPV formula. And in this formula, we used our 10% cost of equity, and we sum all of the cash flows. And we got that Coca-Cola value per share is $61.51, which is pretty close to the current stock price. So in other words, the value of the stock is the present value of the dividends it will pay over the investor's horizon, plus the present value of the expected stock price at the end of that horizon. In this example, the value per share is less than the current stock price, which means that Coca-Cola price is currently overvalued. But the difference between our price and the market price is very small. And this is how you can detect and spot which stock is currently over or undervalued. If this value per share was higher than the current stock price, then the stock is undervalued, which means it's a good buy. But be careful when doing this calculation. In the beginning, we set our ROI to be 12% and the cost of equity was 10%. If you Google it, during the past 13 years, Coca-Cola's highest ROI was 49% and the lowest was 6.22%. And the median was 27% in the beverages non-alcoholic industry. And for the cost of equity for Coca-Cola, calculated via the capital asset pricing model, is around 6%. So be careful when you set your parameters. Thank you for watching. When evaluating our investment, we can also have other criteria to consider. And this would be the internal rate of return, or IRR. IRR is simply the discount rate at which the net present value of our project equals 0. Let's calculate the IRR for our example. Just type in equals IRR, open parentheses, and then select all the cash flows, including the initial investment, and press enter. And we got 15%. What does this mean? As we explained before, the NPV rule states that you invest in any project which has a positive NPV when its cash flows are discounted at the opportunity cost of capital, or WACC. The IRR rule states that you invest in any project offering a rate of return that exceeds the opportunity cost of capital. In this case, our IRR is 50% and our opportunity cost of capital is 12%, which means you should go with this project. If you earn more on a project than it costs to undertake it, then you should accept it. Generally speaking, the higher an internal rate of return, the more desirable an investment is to undertake. The ultimate goal of IRR is to identify the rate of discount, which makes the present value of the sum of annual nominal cash inflows equal to the initial net cash outlay for the investment. So if we would discount all of our cash flows using this internal rate of return, we would get the following. The formula works the same. It's basically the cash flow of each year divided with 1 plus the rate to the power of number of years. And we can copy the formula for the rest of the years. So the sum of our discounted cash flows is equal to our initial value. WACC is a measure of a firm's cost of capital in which each category of capital is proportionally weighted. So all sources of capital, including common stock, preferred stock, bonds, and any other long-term debt, are included in the WACC calculation. In theory, any project with an internal rate of return greater than its cost of capital should be profitable. And in our example, our IRR is greater than WACC, and this project is profitable. One thing to mention here is that IRR can sometimes be misleading when comparing two mutually exclusive projects. In that case, focus more on NPV, because higher IRR for a project does not necessarily mean a higher NPV. In this video, I will show you how you can calculate your loan repayment schedule. I'm here to help you learn everything that you need to know about interest, principal, and monthly payments. In our example, we will work with a loan that has monthly payments. We want to buy a house and we need $500,000 to finance it, so we will take out a loan from a bank. The annual interest rate is 4%, and we would like to repay this loan within 20 years. And now we want to know how much we need to pay each month. First, we need to determine the number of periods or months that we have in which we will make equal monthly payments. If we have 20 years, we would have 240 months. 20 years times 12 months that's 240. Then we also need our monthly interest rate. Our annual interest rate is 4%. When divided by 12 months, we have 0.33% monthly interest rate. We have everything for now to calculate our monthly payment. And for this, we will use the Excel's PMT formula. Enter all inputs that we need for our formula. So we have the rate, which is our monthly interest rate. Then we have the number of periods, which is 240 months. And we need the present value of our loan, which is $500,000. And we will put the minus sign in front of the payment formula in order to get the positive monthly payment. And our monthly payment is around $3,000. But let's break this down and see what portion of each of our monthly payment is the interest and what's the principal payment. And for this, we're going to need our amortization schedule. Our table will have 5 columns, one for month or period number. Then we would have the payment, the interest payment, the principal payment, and the remaining debt or balance. For the period, we need 240 rows because we have 240 months in our 20 years. Our payments are the same for each month, and you can link the cell, lock it, and then copy it to the bottom of our table. And we can break this payment into 2. For the first month, our interest payment is the largest because we need to calculate the interest on the full loan amount. And our interest payment would look like this. It's the $500,000 multiplied with the interest rate. And our principal payment is the difference between the payment and our interest payment. And then we can calculate how much we'll still need to repay to the bank after we make this first payment. So our remaining balance is the full loan amount minus the principal payment. Excellent. For our second month, the only thing that is changing is that we are multiplying the residual debt with the interest rate. And you can now lock this because we're going to copy the formula to the bottom. The principal payment is the difference, and the remaining debt is also the difference between the last month residual debt minus the principal payment. And we can copy the formula for all the remaining months. If done right, you can see that in 20 years, we have paid out debt and it should be 0. With this table, you can see how your interest payment is decreasing with years. The mortgage loan amortization table, the amount going to our principal starts out small and gradually grows larger month by month. Thank you for watching. Hi, in this table here, I have one example of the free cash flow analysis that was done previously. And we obtained that our net present value is positive, which means that the project is good to invest in. However, in this example, we worked with few assumptions in order to calculate the future sales and costs. And in finance, we would always like to know how the change in one variable will impact the other. And that is why we have the sensitivity analysis. Sensitivity analysis is the study of how the uncertainty in the output of a model can be apportioned to different sources of uncertainty in the model input. In order to find it out, we will use data table in Excel. In our example, I would like to know how my NPV would change if my sales in units were different. Let's make a small table. I will first need my base number, and this would be $2,685,000 in sales. And I would copy this number in my table. And I would like to see what happens if my sales were 10 and 20% lower than the baseline and 10 and 20% greater than the baseline. And the last thing that I need to link my NPV to our new table. Excellent. What we're going to do now is select the entire table, click on Data, What If Analysis, and then click on Data Table. In this case, we only need the column input number because this is how we created our table. And for the column input cell, this would be our original sales in unit cell, which is D14, and you would click OK. We got our result, and you can see how our NPV would change if sales in units were lower or greater. A 10% decrease in sales in units would have a great impact on our NPV. You can also do this table with two variables. Let's say we have the price per unit and the fixed costs. Let's start with the baseline numbers. For the fixed cost, our baseline number is 1.5 million and the price per unit is $2. And now you can add the percentage changes. And don't forget to link the NPV to our new table. Excellent. Now again, select the entire table, click on Data, What If Analysis, a Data Table. For the row of input cell, in this case we have the fixed costs from our original table. And for the column input cell, we have the price per unit. Click OK, and you can see how our NPV would change if the fixed cost and the price per unit were changed by a certain percentage. We can do another very useful table setup in order to change between possible scenarios. Scenario analysis is a process of examining and evaluating possible events or scenarios that could take place in the future and predicting the various feasible results or possible outcomes. We always have a base scenario, and then we set our worst case and best case scenario. Let's look at our table. We have different variables that we want to look at. I have sales in units, price, fixed costs, initial capital expenditure, and the weighted average cost of capital. For the sales in units and the price, our best case is 20% higher, and our worst case is that these two are 20% lower. For the fixed costs, CAPEX and VAC, it is the opposite. It's better for us for our costs to be lower, and it's worse if these costs are higher. So let's fill out our table. We always need a column for a scenario code. The base case is 1, best case is 2, and the worst case is 3. You can copy these numbers for the rest of the variables. Perfect. And let's fill out the base numbers. Copy the numbers from the original table. Let's do this for the sales in unit. Then do it for the price. For the fixed costs. Initial capital expenditure. And don't forget to make this as a positive number and copy the weighted average cost of capital. Excellent. We can calculate the changes now. What we have to do now is use our index formula to reference our results. So type in equals index, select our possible options, and then for the row number, we will link this to the scenario code cell. Copy this formula for the rest of the years. And do this for the remaining variables. Perfect. And the last thing that is left for us to connect are the scenario code numbers. We want each variable to be connected to the ultimate scenario choice. Just connect each cell to the scenario code. Perfect. And now you can easily pick your scenario possibility. And when you choose one, you can see how your table changes and it iterates between the numbers and options. This scenario analysis table is very useful when you have multiple tables, multiple worksheets in one Excel file, and you want to have a summary page of some kind where you can change between the possible scenarios and analyze your data. Thank you for watching. We often need to analyze a company's financial statements. And this analysis goes beyond just looking at the balance sheet or profit and loss statement. This is why we have ratios to get a complete picture of the company's performance. Ratios standardize numbers and facilitate comparisons. And ratios are used to highlight weaknesses and strengths. And the ratio comparison should be made through time and with competitors. We can have trend analysis, industry analysis, and benchmark analysis. And these ratios can be split into 5 major categories. We have liquidity ratios, which gives us an idea of the firm's ability to pay off debts that are maturing within a year. Then we have asset management ratios, which give us an idea how effectively the firm is using its assets. Then we have debt management ratios, which gives us an idea of how the firm has financed its assets, as well as the firm's ability to repay its long-term debt. Then we have profitability ratios, which gives us an idea on how profitable the firm is operating and utilizing its assets. And the last category is market value ratios, which bring in the stock price and give us an idea of what investors think about the firm and its future prospects. But let's see this in practice. I have pulled out data for one company, and I have profit and loss statement and balance sheet ready. And I have calculated our ratios. Let's analyze them. Current ratio measures the ability of the firm to pay off its current liabilities by liquidating its current assets. It indicates the firm's ability to avoid insolvency in the short run. Usually, analysts perceive current ratio of 2 as acceptable, and in our case, the liquidity is stable. Quick ratio is a better measure of liquidity than the current ratio because inventories and other less liquid assets are deducted from the current asset. Inventories are typically the least liquid of the firm's current assets, and if sales slow down, they might not be converted to cash as quickly as expected. Return on assets, or ROI, shows how much net income is generated by total assets. It's obviously better to have a higher than a lower return on assets. One quick note is that a low ROI can result from a conscious decision to use a great deal of debt, in which case high interest expenses will cause net income to be relatively low. Stockholders expect to earn a return on their money, and this ratio tells how well they're doing in an accounting sense. However, if a high ROE is achieved by using a great deal of debt, the stock price might end up lower than if the firm had been using less debt and had a lower ROE. In our case, the ROA is okay. Everything that is above 5% is good, and everything that is above 20% is excellent. But we can see that our ROA has been slowly deteriorating with years. And our return on equity is also good. Return on sales is a financial ratio that calculates how effectively a company is generating profits from its top line revenue. And for most companies, a return on sales between 5 and 10% is excellent. And in this case, ours is 6.72%. Operating margin measures operating income per dollar of sales. And in our case, each dollar gives us 12 cents. Net profit margin measures net income per dollar of sales. And in our case, $1 of sale generates 0.06 of net income. As a rule of thumb, 5% is a low margin, 10% is a healthy margin, and 20% is a high margin. And we are doing relatively okay. We can also calculate the return on invested capital. In this case, profitability of the business is decreasing with years because our economic value added is negative. And this is the estimate of the value created by management during the year. Economic value added, or EVA, differs substantially from accounting profit because no charge for the use of equity capital is reflected in accounting profit. And EVA measures all the costs of running the business from both operating and financing. Our debt management ratios, or leverage ratios, shows that we are dealing with the high leverage, and we have 88% in 2015. And our assets are 8 times higher than our equity, and the time interest earned tells us whether we can repay our loan with operating income. In this case, we can cover 5 times our obligations, but this has been decreasing with years. For our asset management ratios or activity ratios, this is a set of ratios that measure how effectively the firm is managing its assets. Basically, this answers this question: does the amount of each type of asset seem reasonable, too high or too low in view of current and projected sales? These ratios are important because when companies acquire assets, they must obtain capital from banks or other sources, and capital is very expensive. If a company has too many assets, its cost of capital will be too high, which will depress its profits. On the other hand, if the assets are too low, profitable sales will be lost. Total asset turnover shows how many times the particular asset is turned over during the year. In our example, this is very low, and it shows how much dollars of sale can be generated by the usage of $1 of total assets. Our fixed asset turnover measures how effectively the firm uses its plant and equipment. A higher turnover ratio is indicator of great efficiency in managing fixed asset investment. Inventory turnover it's okay because $1 of inventory generates $5.2 of cost of goods sold. In general, efficient firms don't tie up more capital than they need in raw materials and unfinished goods. Our supplier's credit could be better. Days of sales outstanding indicates the average time firm must wait after making a sale before it receives cash. And in our case, this is too long because we have to wait 426 days to get cash. So the company should fix its credit policy. And we have enough inventory to maintain business for 69 days. But we need to pay our suppliers very quickly, within 136 days. And there's a huge mismatch between this number and this number. So we have to wait for a very long time to get paid, and we have to pay our obligations quickly. Then we have our market value ratios. Earnings per share indicate how much money a company makes for each share of its stock, and it's widely used metric for estimating corporate value. The higher a company's earnings per share, the more profitable it is considered to be. And then we have the price to earnings ratio, which is the ratio for valuing a company that measures its current share price relative to its earnings per share. In our case, price to earnings ratio is high, and it means how much we are willing to pay for the stock. And this is because our company is not considered risky. And for the last analysis, we have dew point equation, which splits ROE into parts to see which factors are affecting the firm's ROE. And in our case, the ROE is not the consequence of good profitability, but the consequence of huge leverage. And you can see how ROE can sometimes be misleading. Thank you for watching. Welcome to another video on financial ratios. Ratios are very useful to see how the company is doing. However, you always need to compare ratios of one company with other companies in the same industry and also with industry average. And you can do this for the last 3 or 4 years. Sometimes one ratio seems bad, but when you compare it with industry average, then you might realize that your company is doing well. In our example, we have 2 companies, Company A and Company B. And we have the industry average. When you don't want to calculate ratios on your own, just go on Yahoo Finance and type in any company that you want to analyze. Under Financials, you will find all the statements that you need to calculate your ratios. And under Statistics, you will find all the ratios that you need. In our example, you can see that the company B has good liquidity ratios, is doing better than company A and better than industry average. ROE is also very good, and our operating margin is also above the industry average. ROA, on the contrary, is poor, below industry average, and the same goes for total asset turnover and inventory turnover. Overall, we can conclude that Company B is a risky company due to high leverage levels and has difficulties with asset management. Thank you for watching. Hi, in this video I will explain the regression analysis. Regression analysis is a powerful statistical method that allows you to examine the relationship between 2 or more variables of interest. It's a way of mathematically sorting out which of those variables does indeed have an impact on something. So let's see this in practice. We have a table and we want to analyze home prices. Our objective here is to explain the variation in home prices using the variation in the independent variables. So we want to see how our independent variables such as square footage, number of bedrooms, and number of bathrooms would impact the home prices. With this, we want to give an answer to a question why home prices vary and does these features impact the home prices. In order to do a regression analysis, first we need to add the analysis pack to Excel. Click on Customize Quick Access Toolbar and then click on More Commands. On the left, click on Add-ins And then if you still don't have Analysis Tool Pack installed, click on it and click on Go. And you want to choose Analysis Tool Pack and click OK. Your data analysis set will show up under Data tab and under Analysis. Let's run the regression analysis. Click on Data Analysis and click on Regression. You will see a pop-up box for the regression specifications. Using this screen, you can then specify the dependent variable, our input Y range, and in our case, this would be our home listing prices, and the columns of the independent variables or input X range, and this would be our square footage, number of bedrooms, and number of bathrooms. If you included the variable names in the column headings, and these column headings are part of the range of observations that you specified, be sure to check the labels box. And we want to create our regression result in a new worksheet and click OK. We got our results. Let's interpret the summary output. The only thing that matters here is the R-squared, significance F, coefficients, and p-value. Multiple R is the correlation coefficient. It tells you how strong the linear relationship is. For example, a value of 1 means a perfect positive relationship, and a value of 0 means no relationship at all. R-squared is the coefficient of determination. It tells you how many points fall on the regression line. In our example, this is 86%, which means that 86% of the variation of Y value, home prices, around the mean are explained by the X values, and 86% of values fit the model. To see if our results are reliable or statistically significant, we'll look at significance F. If this number is less than 0.05, then we are okay. If this number was higher than 0.05, we would delete a variable that has a high p-value, such as number of bedrooms, and we would rerun the regression until our significance F drops below 0.05. And we can see that there is positive relationship between square footage and home prices. So the larger the square footage, the higher the home price. And the coefficient of 89 indicates that on average, an additional square foot increases the home price by $89. And we also see that the other independent variable, such as number of bathrooms, is also positively related and explains the variation in home prices. For the number of bedrooms, we have a p-value that is higher than 0.05, and this is not statistically significant and indicates strong evidence for the null hypothesis. So this is regression analysis for you. Thank you for watching. Let's see how we can use regression analysis to spot under and overvalued stock. We have P/E ratio of firms in the aerospace industry from the 90s, and we have data for expected growth rate and beta as well, and payout ratio. Beta is a measure of stock's volatility in relation to the overall market. A stock that swings more than the market over time has a beta above 1. A zero beta means that the stock is not correlated with the stock market. Now let's first calculate the average and the median for our table. The average P/E ratio of the industry is 13.2, and the median is 12.25. These ratios give us an estimate of the overall attractiveness of the industry's earnings, and we can now compare each P/E ratio with the average. We use if statement to check if the P/E ratio for each company is greater or lower than the industry average. Those companies that have P/E ratio greater than the average are overvalued, and those who are below are undervalued. However, we need to be careful before jumping to conclusions. We know nothing else about these companies. What's the size, what's the growth potential, and investment opportunities. Parameters have to be the same to make a comparison. And this was just our estimate. Whenever you compare something, compare companies that are similar in size, that are similar in growth potential, and that have similar investment opportunities. Regression analysis can help us to discover undervalued and overvalued companies. We can control for difference across companies on risk, growth, and payout. With regression, we can calculate predicted PE ratio for each company. So click on Data tab, click on Data Analysis, and then click on Regression. Our input Y range is our PE ratio. And for our input X range is the expected growth rate, beta, and payout ratio. And we would like for our regression analysis to be in the same worksheet because we're going to use it for our formula setup. Excellent, we have our regression. Once you have your regression, you can set up your formula. Our predicted PE ratio would be equal to intercept from our regression analysis, and you can lock this, plus the first X variable, which would be our expected growth rate, times the expected growth rate for each stock, plus our second X variable, which is the beta, times the beta for each company, plus our third X variable, which is the payout ratio, times the payout ratio for each company. And you can copy the formula for all the companies. We have our predicted PE ratio. And you can see now that we use regression when we want to predict the future happening between a dependent variable and one or more independent variables. With this formula, we have a better PE ratio for each company. And if you calculate the change, and if you make the comparison with the predicted PE ratio, you can see the difference. Some companies that were overvalued are now undervalued, and some that were undervalued are now overvalued. Regression in our example is based only on few inputs, such as expected growth rate, beta, and payout ratio. And if we had more inputs, our regression would be even more accurate. Thank you for watching. In this video, I will explain correlation. I have a very similar table to the one that we used when we talked about regression analysis. In this table, we used regression analysis to calculate the expected price per share to sales per share ratio. For this regression analysis, we used price to sales ratio as our Y input range, and our expected growth rate, payout ratio, and operating margins were our X variables, or the independent variables. One very useful function in Excel is correlation. The correlation coefficient, a value between -1 and +1, tells you how strongly two variables are related to each other. We can use the correl function or the analysis tool pack add-in in Excel to find the correlation coefficient between the two variables. But in our example, we will use correl function. And we can find correlation between price to sales to operating margin. So type in correl and then select the price to sales ratio and the operating margin. We can use the same for price to sales to expected growth, and price to sales to payout ratio. A correlation coefficient of plus 1 indicates a perfect positive correlation. As variable x increases, variable y increases. And as variable x decreases, variable y decreases. We do not have a perfect correlation, but we have two positive correlations. Generally, a value greater than 0.7 is considered a strong correlation. So we have a strong positive correlation between the price of sales to operating margin and price of sales to expected growth rate. Anything between 0.5 and 0.7 is a moderate correlation, and anything less than 0.4 is considered a weak or no correlation. And for the price of sales to payout, we have a negative correlation, which indicates a negative relationship between these two variables, which means as one increases, the other one will decrease, and vice versa. Thank you for watching. We already talked about ratios and how to calculate them. These ratios are also very useful when deciding in which stocks to invest in. I have 6 companies here, and I have the closing price on Friday, February 18 of 2022, and I have important ratios that I want to look at. I have $1,000 that I want to invest in, and among these 6 options, what would be the best one? PE ratio should be low. Everything less than 15 is good. But I'm dealing with technology sector here, and my PE ratio is high for each company. What is a good or bad PE ratio will depend on the industry in which the company is operating. In general, lower PE is like a lower price tag. The higher the PE ratio, the more you are paying for each dollar of earnings. So our good options here are Apple, Cisco, and Microsoft. Price to sales ratio should also be low. The lower the PS ratio, the more attractive the investment. Again, Apple, Broadcom, and Cisco have the best ratios. Price to book ratio is important because it can help investors understand whether the market price of a company seems reasonable when compared to its balance sheet. Any value under 1 is considered a good value, indicating the undervalued stock. But in our case, our stocks are trading at premium. So we won't mark any of these for now. Let's focus on other ratios. Price to free cash flow should also be low, but the value of less than 15 to 20 is generally considered good. So in our case, we will focus on Apple, Adobe, and Cisco. Why? Well, because the average for our 6 companies is 45, so everything below that is good. A good earnings per share should be a positive figure that has a long track record of consistent growth. Earnings per share indicate how much money a company makes for each share of its stock. A higher earnings per share indicates greater value because investors will pay more for a company share. So in our case, Adobe, Broadcom, and Microsoft fit into this narrative. Return on assets is a financial ratio that shows the percentage profit a company earns in relation to its overall resources. ROA gives an indication of the capital intensity of the company, which will depend on the industry. Companies that require larger initial investments will generally have lower return on assets. And ROIs over 5% are generally considered good. The higher the better, so Apple, Microsoft, and NVIDIA. Return on equity is a measure of financial performance calculated by dividing net income by shareholders' equity. ROE is especially used for comparing the performance of companies in the same industry. As with return on capital, ROE is a measure of management's ability to generate income from the equity available to it. So return on equities of 15 to 20% are generally considered good. In our case, Apple, Microsoft, and NVIDIA are great. Debt to equity should always be low. It's a measure of the degree to which a company is financing its operations through debt versus wholly owned funds. Generally, a good ratio is lower than 1. Everything higher than 2 is very risky. Operating and profit margins don't need much explanation. All of these are very good. And for the enterprise value to EBITDA, the lower this ratio is, the more attractive the stock is because it means that the stock is potentially undervalued. But higher ratios are expected in high growth industries such as this one, and lower multiples in industries with slow growth. Broadcom and Cisco are doing well. So in conclusion, comparing only these 6 stocks, we can see that Apple, Cisco and Microsoft have the best ratios. Thank you for watching.